Investing can often feel like this exclusive club with a secret language, right? But what if I told you there's one simple key that unlocks the door for pretty much everyone? Well, that key is an investment fund. And over the next few minutes, we're going to break down exactly how they work and which one might be the perfect fit for you.
So have you ever felt totally overwhelmed by all the investing talk out there? Yeah, you're definitely not alone. For most people, the biggest hurdle isn't even finding the money to invest. It's that paralyzing fear of picking the wrong stocks. But here's the good news. There's a brilliant solution designed to solve that exact problem. They're called investment funds.
All right, here's our game plan. First, we'll get the big idea behind all funds. Then, we'll meet the four main types you've probably heard about. After that, we'll tackle the most crucial difference: active versus passive investing. We'll put them all side by side to see how they stack up, and finally, help you figure out which one might actually fit your own goals.
All right, let's start at square one. Before we get lost in any of the jargon, what even is a fund? Well, at its heart, it's all about teamwork. It's about pooling your resources together to do something powerful that you could never, ever do on your own.
So, what are we really talking about here? Stripped down, a fund is simply a big pot of money collected from lots of different people. And then a manager uses that collective pot of money to go out and buy a whole bunch of different investments, like stocks and bonds.
Okay, let's forget stocks for a second. Let's talk snacks. Imagine you're at the store, you've got $2, enough for exactly one snack. Kind of risky, right? What if you pick the one you hate? But instead, you and 3 friends each chip in your $2. Bam! Suddenly you have a powerhouse pot of $8. You can buy all 4 snacks, and everyone gets to try everything. If one of them is terrible, who cares? You've still got 3 others to enjoy. That simple idea, spreading your risk and boosting your buying power, is exactly how an investment fund works.
So let's swap those snacks for stocks. As you can see here, this fund shopping basket is filled with 5 of the biggest companies on the planet: Apple, Microsoft, Google, you name it. Now, if you invest just $5 into this fund, that one $5 bill is instantly split up, buying you a tiny little piece of all 5 of those companies at once. And that is the magic right there. You get instant diversification with just one single purchase.
All right, so now you get the basic idea, this whole teamwork thing. Let's meet the main players you're going to see out there on the field. You'll likely run into these 4 types of funds, and each one has its own unique personality and strategy.
First up, we've got the original gangster, the mutual fund. This is the classic model. Your money gets pooled together, and a professional manager actively tries to pick winning investments to make that pool grow. The 2 things you got to remember about these are, you can only buy or sell them once a day after the market closes, and they often have a minimum buy-in, maybe a few $100 to get started.
Next up are index funds, and their goal is the total opposite. Instead of trying to beat the market, an index fund's whole mission is just to be the market. It does this by automatically buying all the stocks on a specific list, or an index, like the S&P 500, which is basically just a shopping list of the 500 biggest companies in the US. And because it's a computer just following a recipe, there's no expensive manager, which means the fees are incredibly low.
Then we have ETFs, or exchange-traded funds. Think of these as the cool modern cousin of the index fund. Most of them do the same thing, they follow an index, but here's the game-changing difference. They trade on the stock exchange just like a single share of Tesla. This means you can buy or sell them any second the market is open. That amazing flexibility, plus the fact you can often get started with just a few dollars, has made them wildly popular, especially for beginners.
And finally, there are hedge funds. Yeah, this is a whole different world. These are basically private, exclusive clubs for really wealthy investors. They use super aggressive and complex strategies trying to chase massive returns. And just getting in the door requires a huge minimum investment. We're talking hundreds of thousands, if not millions of dollars.
Okay, so we've kind of danced around this, but let's make it crystal clear. The single biggest, most important difference between most of these funds really boils down to one simple question. Are you trying to beat the market, or are you just trying to match it?
This lays it out perfectly. On one side, you have active management. That's what most mutual funds and hedge funds do. It's like hiring a celebrity chef. You pay them a higher fee to use their expertise to pick all the ingredients and make decisions, hoping they cook up something that beats everybody else. On the other side is passive management, the engine behind most index funds and ETFs. This is like following a simple, proven recipe. The goal isn't to be creative, it's just to deliver the market's average return for a very, very low cost.
All right, it's time to put all the pieces together. Let's look at these funds side by side in one simple, powerful chart so you can see exactly how they differ.
This is where it all clicks.
First, let's just talk about cost for a second. A typical passive ETF or index fund might charge you less than 0.5% a year in fees. That is incredibly low. It means more of your money actually stays invested and working for you.
Now, let's flip that coin and look at accessibility. For a hedge fund, the price of admission isn't some tiny fee. It's a minimum investment that starts at $100,000 and goes way, way up from there. This really shows you who each of these funds is built for.
And here it is. This is the whole explainer on a single slide. Just look at the huge contrast. Check out the fees row. It goes from very high all the way down to very low. Or look at the min invest row, going from none for an ETF to very high for a hedge fund. Seriously, if you're going to pause or screenshot one thing, this is it. This is your cheat sheet for understanding the world of funds at a glance.
Okay, so we've covered the what. Now for the most important part, the so what. How do you take all this information and actually apply it to your own life and your own goals?
So, which is right for you? Well, let's start with your personality. Are you the kind of person who wants the power to react to market news in an instant? Then the flexibility of an ETF is perfect. But if you know you'd be tempted to nervously check your portfolio every 5 minutes, the set it and forget it nature of a mutual fund, which only gets priced once a day, can actually be a huge plus for your peace of mind.
And what if you're just starting out and don't have a ton of money to invest? The answer here is pretty clear. ETFs are the undisputed winner for accessibility. No minimums, super low fees. Index funds are a fantastic close second. Mutual funds are a solid option, but you might need to save up a bit first. And hedge funds, well, as you can see, for most of us, they're not even in the same ballpark.
And now we get to the most surprising, most counterintuitive twist in this whole story. You'd think that the expensive funds with the highly paid managers would get the best results, right? I mean, that's what they're paid for. But decades of data show that the exact opposite is often true. Simple, boring, low-cost passive funds frequently come out ahead in the long run. The big question is, why?
Well, it really comes down to two simple truths. First, consistently picking stocks that do better than the market average is incredibly, incredibly hard, even for the smartest people on Wall Street. And second, those higher fees that active funds charge act like a financial anchor. Year after year, that small percentage creates a constant drag that just eats away at your potential growth.
So this all leads us to one final powerful question to think about. Is that glamorous goal of beating the market, the very thing that fuels so much of the financial world, actually a distraction for most of us? The evidence seems to suggest that the simplest path to building wealth isn't about trying to find a needle in a haystack. It's about just buying the whole haystack with a low-cost fund. Something to consider on your investment journey. Thanks for digging into this with me.